after last week, the market looked like it was perking up. But then with a short trading week this week, we had seen a lot of downside. Let's talk about what we should expect from the market this week. Good evening, my fellow Riz Elite members and all of our subscribers on YouTube. Welcome to our Elite webinar. My name is Chris. I'm part of Riz International, and we are a group of traders looking to try and make our money work for us and not the other way around. And if that's something that you like and you want to see more content like this, make sure you smash that like and subscribe button below. Really help us get this channel going so that we can get the news out to more traders to help them be successful in the market as well. And we are blessed this evening to have the man himself, Riz Memon, with us. Riz, how are you doing?
Doing good, Chris. Yourself?
I am doing great. I'm glad to be here. It has been a bit of a short trading week because of Juneteenth on Monday. But man, after last week, we saw just this massive rally in the market. There was a lot going on. Everybody was happy, euphoric. Everybody was buying in. Looks like risk off. And then this week we had a huge gap down to start Tuesday's trading with, and really just a really solid downtrend this entire week. So, Riz, what has been going on in the market here for these past couple weeks?
Yeah, I could chalk it up to profit taking. Not surprising at all. I know 2 weeks ago, I think it was 2 weeks ago, maybe three, I was on last and I said, look, the RSI is getting up there. Not to say that it's only because of the RSI, but it's something we want to just track, just be aware of. We don't solely trade off of any indicator. But really, it was not surprising. And I even drew that conclusion back to 2023 earlier. And I think it was February, just a little bit before March, where we saw the market kind of reach just that, February 22nd, just touched that little RSI area, overextended, and then it kind of went lower. Not to say that's going to happen exactly this time around, but this pullback was not surprising to me. I've been in a little bit of heavy cash, obviously have a few long positions still, but we did actually have a good solid week. We shorted some stocks, a couple of stocks, AMD and Oracle. AMD worked out really well. Oracle worked out, but was a little bit more of a slower mover. And then, of course, when I got out for profits, it kind of just went a little bit lower, but I'm okay with that. That's fine. It was pretty much gone parabolic. So it was a good short on our end for both those stocks. And of course, we closed them. So, waiting for this weekend to end and then really kind of start fresh with kind of re-evaluating where the market is. I'm not surprised. Like I said, we got this pullback. I was anticipating the 43.50 area, which, if you can see, 43.48 is where we kind of closed on the SPX. And that worked out well. That 43.50 is, you could kind of consider a sort of a pivot point, a sort of an area where it's short-term support. It's not a hard long-term support, but it is a key area for the short term, with the next level being the 4,300 as you already have on the chart there. So it will be interesting to see if we do get a little bit of a continuation this coming week. Then we could see 4,300 next. I know it's for lack of saying the obvious, I think 4,300 could be doable, because the market's really gone up significantly. There's been a lot of FOMO, a lot of buying in from retail and even some institutions closing their shorts. So I feel like we're due for a pullback. And of course, I put my money where my mouth is. And as a result, I have been significantly heavy in cash as well, and really decreasing my long positions here, as elite members know in real time. So I'm pleased with how we've navigated this short week with the shorts. And this coming week, full trading week, we are getting to the end. Chris, we're getting to the end of Q2, right? Yeah.
Yeah, it's crazy.
Q2. Oh, my God. Yeah, 2023 halfway. We're going to be done the first half of 2023 in about 6-7 days.
Like
6 days, 30 days, 6 days. Yeah. So, damn, Chris.
Where'd the time go?
Where'd time go? I'm getting old. You're still young as ever. So it's nothing really changes. As things change, some things remain the same. So I age exponentially. You, my friend, look chipper as always. So with that said, I think we continue a little bit lower. I personally would welcome it. I would welcome it.
Yeah.
You know me, guys, I thrive, and I don't want to sound like, as I always say, I want to be modest sometimes. Chris, am I a little bit too modest sometimes, or
Sometimes, yes, I agree with you
sometimes?
on that.
Okay. I mean, I'd rather be a little bit too modest than the other way around. But I feel like I operate better in more turbulent markets. And what I mean by that is when they don't just go up, 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 up. Because, that we've seen that happen in 2021. And that wasn't the most ideal market. Even though I made money that year, it wasn't the most ideal market for me. But when we see markets go turbulent, when they start struggling, when they go lower and fear kicks in, that's where I come into my own. And OG traders, OG people who have been with us in Elite or following me, Riz International on our YouTube, Instagram, so on and so forth, really know that that's my kind of thing. That's where I operate the best. So I welcome pullbacks. Of course, markets going up in the long run is a given, but I welcome pullbacks. So 4,300 is one you want to keep an eye on, guys and girls. And let's see what we do going forward. But there's still a lot of froth. I think we went from quite a few tech companies, large caps, and some of the lesser known smaller caps being undervalued to now being significantly frothy and a point where I can't even justify buying things like Apple, for example. Even though Apple's a fantastic company, great business, I can't justify buying in at these levels, right? So it goes to show you how this pendulum swings, okay? And it's important to understand that. And you could see even on the RSI, Apple remains overbought. You could see that it's been overbought since really the start of June. Maybe you could consider even longer, May, because look, it's just always elevated, always in and around that 70 area on the RSI. So classic example of what remains overbought, quote unquote, can remain that way for months. So very interesting to see.
Yeah, a lot of tech companies going absolutely nuts, and you can see that here on the breakdown for the S&P 500. This huge spike from tech here back in the end of May, rather, with all the AI craze. Honestly, it's anybody mentions AI in their business plan, and it seems to just go to the moon. But we've seen that those things will come down based on our shorts that Riz was talking about on AMD, Oracle. Those worked out pretty darn well. But communications, which of course is part of tech, is also kind of following the trend with it. And what's really been going nuts since, this time period is, this consumer discretionary, where people seem to think that things are going good and they can throw their money into, things that they otherwise wouldn't necessarily need. They aren't, staples, which we'll notice is underperforming, as you might notice here with the XLP, though it is right at near the zero line. But, S&P 500, up here by the SPY ETF by almost 13%, I should say, checking in at about 12.71, but tech up a whopping 36.82% on the year so far, while the other indices are all underperforming. Now, not terribly so. We're not in the negative double digits on anything yet, but, healthcare, real estate, financials, utilities, energy, all down below the zero line. Consumer staples really close to zero, and it kind of touched zero. Look here on Thursday, it kind of got there, but really, we are being propped up by these three parts of the market. And, we've seen this before. If I'm not mistaken, it was back in 2020 where tech was just going crazy. Riz, does this kind of look mostly just like risk off in these companies because people think that AI is the next, blockchain, for lack of a better term?
Yeah, well said. I do think that now the discerning factor between blockchain, aka this novel construct that didn't turn out to be much of anything, over these years. Whereas with AI, we could see it. It's visual. Like even I am in certain things impressed, and in sometimes a little bit scared as to where it's going and where it can be. So yeah, AI is not some fairy tale concept. It's here. It's been here. It's just now even more in our face with ChatGPT, with OpenAI, and other companies, Microsoft, being really heavy in it, and Google coming in with it. And of course, it's just going to scale from there. So the market is really very much thinking, and individuals and institutions thinking that AI is the next frontier, which it can be. I just feel like anytime, whether it's blockchain, whether it's AI, it always swings to over optimism, and then eventually, we don't know exactly when, but eventually the reality starts sinking in, and then people realize, oh wait, blockchain, or what it really is it, and how it's really benefiting companies. In that case, it didn't. With AI, I think we're going to see some benefits regardless of whether they're in banking, whether they're in really every single industry is up for disruption, and from a fact of efficiency. So companies we've already seen have laid off or fired a portion of their workforce in certain departments. Primarily could be the admin department, could be certain departments where they just completely let them go and replaced it with automation, with AI. So it's interesting to see, and there are some speculations where, like, AI can increase um, overall profits in the hundreds of billions as an aggregate for corporations, simply because of the efficiency and get it provides. You have less people in the work force for a company, more profits. Because we know for majority of companies, the largest expense is employees.
Human capital.
So once you replace them, it sucks for the employees, right? It sucks for the employees. There's going to be some segments in the economy which will be bolstered and reinforced, and with AI, meaning certain jobs, certain employees will be able to use the assistance of AI to make their job more easier, efficient, for the boss positive of the company. But there's going to be others, like we've seen, where complete letting go, complete removal of human beings, and just complete replacement by AI. So that's actually bad. That's the scary part. That's where we realize, well, how far does it go? And I'm not going to get too philosophical about it right now, but there could be a world where majority of humans may not be working, and that, I'm not going to get into that here because it's a very long-winded subject and something that I find pretty interesting and albeit a little bit scary as well. But that's where we could go, where we are seeing that. And the funny part is we haven't seen that come into play yet with unemployment, because what's really good for corporations for a profit standpoint, it's actually negative for human beings in a workforce, because what does that do? Less people doing clerical work, admin work, less people doing certain jobs because AI is doing it. What does that mean? Where does that leave them? Are they able to switch to different industries? Are they able to get that training and move into different jobs? Or are they out of the workforce? Are they unemployed? And are they demotivated unemployed individuals? Which means if they're demotivated, then they are on social assistance, and that's bad, right? As it is, we know that Social Security, all these things are underfunded, and they may implode and run out of money in the next decade or so. So it's going to be interesting. And I don't want to scare people or come in with doomsday theories, but we just want to be open-minded and kind of preempt a little bit. It doesn't mean we want to jump to conclusions, but we do want to be aware, and that's really our thing. Being aware individuals, not just aware traders and investors, but aware individuals. And I think if that we can do half decent with, we'll be better suited as human beings and, of course, as traders.
Definitely. No, that's a really good insight and very true. AI definitely is making a big impact, and we're seeing that with tech and communications just going nuts here. Let's take a look here at the asset classes, and man, oil just does not want to get away from $70. I mean, oil just seems stuck here. Looks like we closed on Friday right at 69.16. That's a nice number. But we just seem to keep bouncing between like 72.50 and about 67.20 or so per barrel, and we just don't want to get out of this rut. We have been in here since the beginning of May. And then, man, looking at gold, what a hard rejection of this all-time high here at 2050.17. That was back here, just FYI, back in early 22. We came really freaking close here in May, but we didn't quite get there, and a very hard technical rejection there on gold kind of coming down, and we saw a lot more dip in gold this week as well, kind of closing out. Riz, I mean, summer's here. Why are people not going on trips? Why is oil hanging out? Is this, we hear about the Saudi, potential cuts, because they want to try and drive the price up. But man, the price just seems stuck so low. What's going on with this?
Yeah, so people are traveling. We have seen more travel. We've seen more seasonal travel via air, definitely. We've also, of course, seen more discretionary spending, as you mentioned. We've seen
Hmm.
more travel overall vehicles. But the one of the reasons oil is down is there's actually a high short interest by a futures contract by institutions on oil because institutions feel like, okay, there's a demand after 2020, everything was lopsided. Everything went upside down where oil went negative, yada yada. But we're at that point where even after the cuts, institutions, predominantly commodities traders, feel like even with excess, even with strong demand right now, we still and factoring in the cuts, we still are in a position where $70 is actually a bit frothy, according to those, right? So according to those institutions and commodities traders, and that's why Saudi and one of the oil ministers from Saudi Arabia said, well, you guys who have a short have a short on oil should should not be short oil. Be careful. Effectively, given a warning sign there. But it's still persisted. So I'm not saying that we can't go higher. I just feel like this channel is pretty decent. It's okay. We've seen periods in oil prices where they just channel, and that's actually the norm. Oil prices are not like AMD or an AI or blockchain type of stock. It's its own thing, and they usually do consolidate. We've seen these things happen for months and months and even years, where overall in the big picture, oil can consolidate. So it's funny where people were like, oil is going $120 a barrel. You haven't seen nothing yet. Well, here we are still consolidating. Month over month after that 123 peak we saw back in May 2022. Yep. June 2022. So yeah, I think those kind of $100 plus days are over for now, especially as we see electric car demand pick up. We have a lot more choices now. The infrastructure picks up a little bit. Is nowhere near replacing ICE vehicles, but it's still there. It's still a viable option. A little bit more than, let's say, 2-3 years ago. So we have seen electric cars increase overall. So we've seen even gas cars be a lot more efficient over the last decade, right? So not surprising that we see oil prices a little bit here, even though demand is still strong. It's the market is and institutions are effectively pricing in the fact that we've reached peak demand. Okay, where it's good, but it might just be the best it gets going forward. So that's one of the reasons we've seen oil kind of consolidate, even with Saudi and OPEC cutting production and just relatively strong short positions from institutions.
No, I remember back here when we peaked at 120, everybody's like, "Oh, it's going to 200, it's going to 150," and yeah, well, we saw how well that worked, didn't we? Here we peaked again. It looked like earlier in March, so that was the real peak. We came again here in June, and then it's been downhill ever since. And I remember you and I talking about this, Riz. It's just like the economy is not sustainable with oil prices this high,
Yep.
and you're seeing that now. And yeah, we're
Every
done.
I remember every week, every 2 weeks, I would come in and say these two words: demand destruction.
Yep.
And I would say this, say it, say it, say it, and people were like, "Oh God, we're so tired of hearing this." And I'm like, "Yep, there's massive demand destruction at 120, massive demand destruction here at 110. We got it. It's just not sustainable." And
Yep.
it took some time, right? Take some time. Everything I talk about, whether it's stocks, whether it's commodities, whether it's currencies, treasury, economy, none of it is, you know, 1 week to the next. None of it is one day to the next. Usually, it takes time, and ultimately, that's what matters. We're talking about months, and sometimes in the grand scheme of things, maybe years. So that's really where trading and investing comes into its own. Where if you're looking at a microscopic time frame, you're just day trading specific stocks or options. For us, understanding overall macro, overall changes and moves in economies, in commodities, I think it's more important because that's the time frame that matters most.
Very good point. Yeah, when you're looking at commodities and things like this, you really have to kind of take a little bit further, time horizon and really kind of dig into that a little bit more. Let's take a look here at the Treasury bond yields, and holy cow, what a jump here in the 2-year bond yields, really going up quite a bit, while the 30 and the 10-year bond yields are really kind of just hanging out, kind of taking it easy. Riz, is this because of the rate pause from the Fed, or is there something else going on here?
So that's very interesting. So that we've seen the 2 weeks since May really go up and break above that kind of consolidation alongside the other Treasury yields, right? So the reason we've seen this is because the Fed, especially if you look at that little dip that we had near the end of May, you can see that ever since then, and it's in the last 2 weeks, the Fed said, well, we still got rate hikes coming. So the moment the Fed signaled was further rate hikes, the market didn't believe them, but the bond market is a big different bag. It's a different bag. They're thinking, okay, yeah, we believe Powell. The bond market believes Powell. The stock market doesn't. And as a result, because Powell said we got a little bit more rate hikes, remember what I've said over the past many months, maybe throughout this year, that higher interest rates, higher benchmark interest rates are going to push up treasuries. So in a result, when Powell said, yeah, although we're not raising this time around, we are anticipating 1 or 2 more hikes, and there at this current point in time, there are no rate cuts planned for 2023. So that's one of the reasons why the 2-year treasury, which is the short-term treasury bond, going up, okay, near term. So it's important. It's significant. That's a significant move. So the bond market is telling us something, and the equities market is telling us completely different, which was, no, we don't believe Powell, stocks to the moon type of thing, right? Risk assets to the moon. So there is a dichotomy, sort of a dislocation between the two.
Yeah, for all of our everybody watching the replay, sorry if I scared you with the dog there. She saw something that she didn't care for. So dollar really kind of holding strong as well, not moving too much, I would say, as of late. Everybody who's saying that the dollar's dying, yeah, it sure doesn't look like it to me. It's comical. Like you said, everybody gets tired of hearing demand destruction. We're here saying that no, the dollar is not going anywhere, and I'm sure wouldn't bet against it looking at a chart like this.
Yeah, it's still strong. Again, weakened overall, but it was too strong before. It was bad for manufacturing before, so bad for imports, exports before. So that was too strong. So right now it's in like a kind of a good zone. Again, this is relative to overall currencies, not one individual currency, right? So that's important to keep in mind. A lot of people were saying, the dollar is going to be, worth nothing, and everyone's moving away from the dollar and BRICS and this currency and that currency. I'm like, sure, but the U.S. dollar is still more than half of all foreign import-export transactions. It's still the reserve currency. It's not going anywhere. And in fact, everyone who was like anti-U.S. dollar, which were mostly Americans, which blows my mind, were like, yeah, but look, it's decreasing. Everyone's going on, changing their views on changing what currency they should use, and the U.S. is no longer kind of that de facto reserve currency. I'm like, first, they're just using other currencies. Doesn't mean they're not using the U.S. dollar, right? So this kind of nuance is lost with frankly morons. It's just unfortunate that there's so many of them, and most being actual Americans, which blows my mind. Like, I mean, you don't got to be so patriotic, but you also don't got to be absolutely against your own country. Like, geez. But anyways, I digress. Ultimately, we've seen, yes, other countries adopt other currencies to transacting, but they're still transacting in the U.S. dollar, and the U.S. dollar is still more than half of all global transactions in currencies. So I feel like even if it's a little bit lower, that's fine. And one thing many people don't realize is one of the reasons of inflation is, a lot of, I would say, demand for the U.S. dollar. So if everything is by what I mean by everything, I mean like when most things are transacted in U.S. dollar, that's going to have an inflationary pressure on the U.S. dollar. It's not bad, but it's also not good either. So when you're dealing with an environment where we have excess inflation in the U.S., which has gone down, having a weaker currency or having less transaction in that currency being less of a reserve is actually not bad. So remember, it's always like a yin and yang. And besides the US dollar, what currency are we going to trust? The Turkish lira, which is like dropped like 90%.
Yeah, you want to see
In value.
hyperinflation? Look at that.
Yeah, you want to see, Venezuela's currency. And I know people will be like, well, Riz, this is what happens when you have socialism. Well, no, Venezuela is not a good example of socialism. It's a good example of absolute fuckery in management of a country and management of the economy, right? So that's what that is. That's a great example of that. Again, it just blows my mind the kind of narratives out there. But ultimately, we've seen China. What are we going to use? The Chinese currency, where they purposely devalue their currency against the U.S. dollar because it benefits them. Where are we going to use that? Where because China tomorrow decides, the CCP decides that, well, no, our currency is too strong. We want to have a weaker currency that benefits our pockets, our balance sheet. So we're going to weaken the currency while everyone else gets shafted. No, you don't want that. The U.S. is actually the most stable, most sought after, most used currency on the planet. And that stands, and I think it's going to stand for the next few decades. What happens after that is anyone's, gig. But everyone that says, well, by the end of this year, Ridge, you're going to be transacting in whatever else. I'm like, fuck. Okay, you be first.
Yeah, right.
I'm like, you be first. All right, you go ahead and just close everything. And when you do leave for China and Russia, let me know. All right. I never hear back from them, surprisingly.
Funny how that works, isn't it?
Yeah, fucking comical.
Right, for sure. I got to agree with you on that one. If you are here on the live webinar, please go ahead and posting your questions. We've had a couple come in, but before we do that, let's take a look at the important dates this week, and we do have a few of them. We've got some durable good orders month on month, looking like things are looking down a little bit on durable goods, but looks like Powell's talking, and it looks like he's talking more than once. That's something to keep an eye on, because that man knows how to move the market by his words. And then we've got some big ones coming in here on Friday for sure. We've got the core PCE price index, personal income and spending, and then looks like the following week, which is going to be short because of the July 4th holiday, we've got manufacturing PMI coming out. So Riz, yeah, I'm guessing we're going to be kind of keeping an eye on things while Powell talks here on Wednesday, Thursday?
Yeah, keeping an eye. Honestly, Powell has the power to move markets, but frankly, he's moved markets in the wrong way. And I think even he realizes that from a stock market standpoint, they don't buy anything he has to say. They don't believe him. He's pretty much, barking away, for lack of a better explanation.
Yeah, that's for sure. So definitely keep an eye on these. But yeah, when Powell talks, the market gets a little volatile, so be aware of that. Speaking of volatility, Sean brought in, has a couple questions for us. It's been interesting seeing the VIX go so low lately, which of course is the volatility index. He says prefers volatility for premium. Yeah, it's definitely something you can do. Riz, just because the market just keeps to push higher and higher, is that why volatility is coming down?
Yeah, this is a divergence 101 where recently we saw the markets go up. Obviously, we saw that big parabolic move. So no doubt, VIX dropping is not surprising. But what we did see was this past week, we saw the markets pull back a little bit. Guess what happened with the VIX? Actually went lower during that time. So that's a divergence. It should be the opposite happening, where markets go down and the VIX should coming up. So really, we're at that point where, like, is the VIX broken? I remember back in my 15 years of trading, there's been plenty of periods in those 15 years where the VIX really came to prominence as the fear index, as people actually started watching it. It wasn't always this case. So, but there's been during the last, let's say, 5-10 years, actually, where there's been times where, like, okay, the VIX is broken. It's not really tracking the market. It's not really following along. Maybe, there is no fear or whatever. But I assure you, there have been periods like this before where we see markets go down, but the VIX goes lower instead of going up. But eventually, it does course correct, so to speak. It does start acting like itself. So that'll be interesting to see when that happens. So it's actually not a bad idea to go long volatility, meaning it's not a bad idea to buy or or I would say trade with a view of the upside in volatility going up. Okay, that's my basis. How people choose to do that? They have a few choices. They can try and trade VIX contracts, futures contracts themselves. Again, that's not under the purview or available to the vast majority. So one way they could do it is maybe trading ETFs that track the VIX, preferably unleveraged, because leveraged ones have more decay. So again, it's more for the savvy, more experienced traders, not for the beginners, because you just want to avoid that. It's one more thing that can go wrong for you. So you're better off if you really feel like there's going to be fear, panic in the market. Instead of doing all this, for the vast majority, it's better to actually close out and cut their long positions and actually go a little bit more cash.
There you go. That's a great way to think about it. Now, Sean also chimed in about the goings on in Russia with the so-called coup. What are our thoughts with that, Riz? I'll get your thoughts on that, and then I'll give you mine.
Yes, we got our Russia-Ukraine correspondent live with Chris here on us.
That's true.
No, it's true. It's very true. I will say, yeah. Well, the whole PMC, the Wagner Group, kind of coup or this uprising, like you said, Sean, it kind of started and fizzled faster than the news cycle could even get a hold of it. So yeah, that's interesting. I'm not gonna speculate on it. It was interesting. I'm actually surprised that it happened, first to begin with, and second that it ended so fast. But hey, here we are. We're in 2023, right? Whatever you think is the most unexpected outcome will likely be the actual outcome. And then I'll leave the rest to Chris.
Yeah, so whether you may know it or not, I'm actually married to a Ukrainian lady, so I have a bit closer contacts to this than Riz might. So it's been an interesting 24 hours. We'll just put it that way. But yeah, I don't think we have anything to be concerned. I know a lot of people were cheerleading this certain thing going on, but let's be honest, guys, and if we're just going to be clear, there's no way a convoy like that is getting within 50 miles of Moscow. I'm just going to put it out there. I'm pretty sure a couple of Su-35s could have taken care of the whole thing. But yeah, it seemed a little weird to me. That's all I'm going to say. I think there's more to it than what we know, and I don't think we're ever really going to know because there are only a few people who know what's actually going on, and they're not talking. So I would say that it kind of reeked of a publicity stunt almost in some ways for Prigozhin to get himself more attention. But let's get to some market questions. All right. Manuel says, earlier in the week, you mentioned that you like healthcare for sector rotation. Are there any tickers you're particularly looking at or interested in? That's an interesting question.
Yeah. So I feel like there's a few. Obviously, there's a few. We've traded some. We have a position in one. Manuel, you know that. I like quite a few, but there's some that are already too frothy from a technical standpoint. One is Lilly. I'm just mentioning them. Doesn't mean they're right for trading, but just showing you for some context. Lilly is a fantastic company. Loved it, but it's way too overdone. I don't have a position. Of course, J&J is not. I mean, it's a pharma healthcare kind of. This is a great company. Obviously, we did trade it. We did, do some make some money off of it, and now it's at that resistance level. So this one's interesting to keep an eye on, from a trade idea standpoint. And then of course we have healthcare is big, so we also have some healthcare, health insurance type of companies. So you have UNH, United Healthcare. This one is another to keep an eye on. Good bounce off the 450 support. This is something I mentioned in our watch list as well a couple times to elite members. We also have another healthcare called Humana. That's something to keep an eye on. This one's also been in a watch list. So kind of not, I think, I would say as ripe of an entry yet, but something to keep an eye on. We also have, bring up ABT, Chris Abbott. This is a great company as well. So again, really, if you want to play that sector rotation, potential sector rotation, these are a few. Again, there's so many, lot of large caps, big pharma there. Some are better from a technical standpoint. Some are better than a fundamental standpoint. I'll let you look into them closer, but these are just some off the top of my mind.
Yeah, absolutely. All right, so Manuel has another question, and I think this is a good one. He says, now that we're halfway through the year, what are your thoughts on the year so far in the market, Riz? And what do you think the sentiment is going to be for the next half?
Okay, great question. Great question. I'm not Nostradamus. I can't tell the future, so I will put that, disclaimer prior to what I say. But I am of the purview that the financial markets finally start pricing in a weakening economy. They start pricing in that, yes, inflation has come down, but it's not at the 2% to 3% key level just yet. And the fact that we might see rates at these levels, not saying it's going to be at this level exactly, maybe a little bit lower, but in this 4% range for the going foreseeable future. And that already is going to impact the risk-free rate. That's already going to impact how things go in from a risk-free rate of return, and of course from a growth standpoint, because higher the rates, the less overall growth we can anticipate, right? So the whole, again, I'm not going to go into the weeds of it, but ultimately it has an impact on growth. We see that. We see it has an impact on borrowing. It has an impact on costs, right? Of course, it costs more to borrow, costs more to invest in something, and the risk return is not as favorable. Even now, people can lock in a cash type of investment for 4 to 5% annualized interest rate return. Why would they try and chase a 7% annualized return in the stock market while risking their hard-earned money? So we already see that kind of play out already. So the higher rates are, the higher they remain, the whole risk reward of being in the financial markets, that whole kind of thing changes. The viewpoint changes, right? In the last 10 years, since 2008, actually 15 years, we've been in a different situation. Pre-2022 rate hikes, we were in a next to zero, close 0% interest rate environment, which led to massive amounts of growth, and which I will say has made the average person complacent. They all think that because if you buy an index fund or ETF, because the market average 8-9% annualized return, they think that's what they're always going to get for the next 10, 20 years. I assure you the next 10, 20 years in the markets are not going to be the same. As globalization changes, as economies change, as technology changes, as people's spending habits change, doesn't mean markets are not going to go up. It just means that we cannot expect that same 15-year annualized return for the last 15 years. We can't expect that going forward. And I think all these people that tell you online, again, nothing wrong with ETFs and index investing, but people that say, well, put $10,000 in and put it in this account, in the next 20 years you'll be a millionaire. That's a big chase. That's a big assumption, because we know, for those of us that have done this long enough, that past occurrences are not a predictor of future returns.
Yeah, absolutely. I mean, just because something has happened one way in the past doesn't mean it's going to keep going that way. And, I will have to say I have to eat some crow. I did not predict the Fed saying that they would pause interest rates. So for all of you down in the comments, feel free to tell me how wrong I was about that. But Powell has said that they're going to keep raising rates. They kind of have to. For the reason that Riz just said, it's like, yes, inflation's more under control now than it was, but they're not where they want to be. So they really only have one weapon left, and that's to keep hiking rates.
I will say one thing, Chris, because I didn't say it as explicitly or simply as I should have. I think market can go lower for the second half.
Oh, I do too. Honestly, I kind of feel like we've had this euphoria. We've had this big push from AI, basically. And yeah, I see a lot of negative catalysts here in the back half of the year. Maybe it pans out, maybe it doesn't. There's no way to know for certain. No one does, and that includes us. Riz and I are just giving you our opinions, and that's all they are. It's not to be construed as financial advice. We're not telling you what to trade here, but yeah, I mean, it feels heavy right now. It feels heavy at the top. It feels like it's inflated a bit and it needs to pop and come back down a little. So and there are a lot of things that could happen here in the second half of the year that can affect the market either direction. So it's one of those things where you have to be nimble in the market to be able to capitalize on it, because, if you put yourself in one mindset, like, oh, it's going to do this, oh, it's going to do this, and then it doesn't, well, then, you've missed out on the potential opposite direction. And I think that that's really where, we're different here in Elite, is that we don't have problems trading the market both directions. We can go long, we can go short. Lots of different ways to trade in the market that we do here in Elite, and I don't want to give those away for our non-Elite members, but there's money to be made no matter which way the market goes.
Yes, well said. I agree.
So, well, awesome. Well, I'm not seeing any other questions coming in at the moment, so I want to thank all of our Elite members for coming out live. Thank you so much for coming out. Yes, have an absolutely excellent rest of your weekend. Go out, have some fun. As I like to say, don't do anything I wouldn't do, which gives you a lot of leeway. And, of course, Riz, thanks so much for coming out. I appreciate it.
Pleasure is mine. Good to finally be on again. Great to have you on video for those that are watching live. Hopefully we can get you on video more. I think maybe some point I might be on video too, but let's see.
Fair enough. We'll take it one day at a time. Everybody have a great weekend, and we will see you in the market on Monday.